Welcome to our weekly briefing. Right now, if you look at the global markets, they're being pulled in two completely different directions. It's a fascinating story. On one side, you have the US economy hitting the brakes and hitting them hard. And on the other, the Bank of Japan is basically locked in place. This growing split, what we're calling the Great Divide, isn't just some market chatter. It is the single most important force shaping where your money should be right now. So let's break this down. In the US, the economy is very clearly stalling out, and that's pushing the Federal Reserve to start thinking about and moving toward cutting interest rates. But then you look at Japan, and they're just stuck. A mix of economic stagnation and some tough political realities has the Bank of Japan's hands tied, keeping their rates right where they are. And believe me, this isn't just theory. This is creating a massive current in the global flow of money, and we absolutely need to understand which way it's going. Okay, so where do we look for the clearest sign that this shift is really happening? Well, it wasn't in the usual places last week. Not in the noisy stock market, not in some geopolitical headline. Nope, the real story, the one that matters, was the powerful, undeniable rally we saw in US bonds. And here it is. This is the market's final verdict. You have to remember, bond investors are the ones who live and breathe this stuff, growth, interest rates. And they are sending a signal that is loud and clear. The main worry is no longer about fighting inflation. Now, it's all about bracing for a recession. This is the new lens, the new filter that we have to view everything through. And just look at how sharp this move was. The 10-year Treasury yield. This is a benchmark for the entire global financial system. It didn't just drift down. It absolutely plunged to a 6-month low of 3.9%. Markets just don't make moves that big without a really good reason. This was a forceful reaction to specific data that genuinely spooked people. So what were those triggers? It really boils down to two things. First, a catastrophically weak jobs report. We'll dig into that in just a second. And second, those fears in the banking sector came roaring back. When Zions Bank Corp reported some unexpected loan losses, it sent this shockwave through the market. It was like deja vu, reigniting all those fears about regional banks. And what did investors do? Exactly what you'd expect. They ran for the safety of US government bonds. And that flight to safety, that rush into bonds, it points us directly to the core problem brewing in the United States right now, a classic stagflationary dilemma. We're seeing data points that are completely at odds with each other, and it's putting the Federal Reserve in an incredibly tough spot. So on one hand, you have the growth story, which is falling apart. The labor market is just grinding to a halt. But on the other hand, the inflation story is still a huge problem, with prices staying stubbornly high. So the Fed has to choose, right? Which fire do you put out first? And just look at this jobs number. Wow, the economy added only 22,000 jobs. The market was expecting 75,000. This isn't just a miss, it's a catastrophic miss. This isn't a slowdown, this is a full-on stall. It's a devastating number that tells you the engine of the US economy, the labor market, is just sputtering out. But at the very same time, you've got this. Core PCE, that's the inflation number the Fed really cares about, is still running hot at almost 3%. So here it is, the collision right in front of you. Growth is collapsing, but inflation is still way, way above the Fed's 2% target. And this is the result. That terrible jobs data basically forced the Fed's hand. When Chairman Powell comes out and says, the time has come for policy to adjust, well, that's a game changer. It's a clear pivot away from your whole higher for longer mantra. The Fed is now telling us that they're going to prioritize growth, even if it means they have to live with inflation that's a little too hot for a little while longer. Okay, now let's hop across the Pacific to Japan. Because while the US Fed is pivoting toward rate cuts, the Bank of Japan is completely, utterly paralyzed. And it's this inaction, this paralysis, that's making that great policy divide even wider. The key to understanding what's going on with the Bank of Japan is this conflict right here. They're caught between a rock and a hard place. On a technical level, the data is telling them to raise interest rates, but the reality on the ground, the political and economic reality, makes that move basically impossible. And right now, reality is winning. So here's the technical signal, the textbook case for hiking rates. For the first time since 2019, Japan's GDP gap turned positive. All that means is that the economy's demand is outstripping its potential supply. Any Economics 101 course would tell you this is when the central bank is supposed to step in and tighten policy to cool things down. But here's the reality. Real wages, that's what people can actually buy with their paychecks after you factor in inflation, fell by 1.7% in August. So think about that. The purchasing power of the average Japanese household is actually shrinking. They simply cannot afford higher borrowing costs. It would be a disaster for them. So when you're looking at collapsing real wages, the political pressure is just immense. A rate hike that would make life even harder for the average family, it's just off the table. That's why we're so confident in this call. The Bank of Japan will not be raising rates in 2025. And that means this policy gap with the US is only going to get wider. Okay, so we've laid out this great divide between the US and Japan. Now we get to the most important question. How do we actually position our portfolios to take advantage of it? Let's start with currencies. It's pretty straightforward. As that interest rate difference between the US and Japan gets bigger, money is going to keep flowing from the low-yielding yen to the higher-yielding dollar. That's why we are setting a new, firm target for the dollar-yen exchange rate, 155. So our core strategy, our game plan is built on 3 pillars. Number 1, we're buying long-duration US bonds to cash in on the Fed's pivot. Number 2, we want to position for a weaker yen, and we'll do that by investing in currency-hedged Japanese stocks. And number 3, across all stock markets, we're playing defense. We're focusing only on high-quality companies. Now let's get specific on the US side. We are overweight long-duration treasuries. They're going to rally as rates fall. We're also overweight quality dividend stocks in those defensive sectors like healthcare and consumer staples, the kind that can weather a storm. And we're overweight real assets like gold, which is the ultimate stagflation hedge. On the flip side, we're underweighting the most vulnerable spots: expensive tech stocks, cyclical companies that need a strong economy to do well, and small caps. Now, for Japan, we need to be a bit more surgical. It's a two-pronged approach. First, we're targeting domestic companies that actually benefit from the Bank of Japan's easy money policy. Think banks, real estate. The second prong is to go after the biggest winners from a weaker yen. We're talking about the major exporters, your auto companies, your machinery companies. Their profits are going to soar when they bring all that overseas money back home to a cheaper currency. So this table really brings our entire global view together in one place. As you can see, we are generally underweight stocks, especially in the US and Europe, where those stagflation risks are highest. Our biggest, highest conviction call is a clear overweight to long-duration US bonds. We think that's the primary winner from this entire macro theme. And of course, we're also overweight gold as a hedge and holding a little extra cash just to stay flexible and ready to act. So there you have it. We've laid out the roadmap. The bond market has sounded the alarm. The world's 2 most important central banks are heading down completely different paths, and the implications for your portfolio are, frankly, profound. The only question left is the one you see on your screen. In this splitting, diverging world, is your portfolio ready?